Greetings, everyone. Scott Richardson and Dan Brown from Richardson Capital Management, here to provide the May 2022 economic and investment update. Well, May certainly was an interesting and volatile month as stocks declined pretty significantly during the first 3 weeks of the month. Fortunately, during the last full trading week of the month, they recovered nicely and finished the month essentially flat. In fixed income, which had been down the first 4 months of the year, also had a relatively flat month to stem the tide from all the negative returns in the early part of the year. One of the main drivers of the concerns during the month dealt with the inflation environment. And with that, Dan, can you give us a quick update on kind of what's going on that front?
Sure, Scott. So inflation remains stubbornly high, in fact, near a 40-year high. So on an annualized basis, inflation for the second month in a row came in at above 8%. And that's unnerving a lot of investors. And a major contributor to that is what we see with going on with energy prices, whether it's gasoline, natural gas, diesel fuel, et cetera. So we saw oil peak during the month at about $119 a barrel. And that meant that gasoline prices, I think for the first time ever, was above $4 per gallon for all 50 states. So that's definitely leading to and contributing to the higher level inflation. And that's got some investors unnerved and concerned, especially as it relates to the Federal Reserve and how they intend to fight inflation.
What exactly did the Fed do in May, and what is our outlook for what they're going to do with interest rates going forward?
Yes, Scott. So the Fed met again in early May, and during that meeting, they raised the level of Fed funds interest rates by 0.5%. And if we recall, a couple months earlier, was the first time that they actually raised interest rates in this tightening cycle, and they only raised rates by 0.25 point or 0.25%. Mm-hmm. So the Fed has changed their stance quite a bit the past couple months, and they intend to fight inflation by raising the level of interest rates fairly aggressive here over the summer. So the other thing that the Fed told us at that early May meeting is that investors should expect the next two meetings for June and July another 0.5 point raise at each of those meetings. And then we'll see what the back half of 2022 holds as far as interest rate increases, but probably expect probably a couple more 0.25 point increases the back half of the year. So it's very possible by the end of this year we could see a Fed funds interest rates at about 2.25% to 2.5%. And what that means for the broader financial markets, especially on the fixed income side, is that we would expect the level of interest rates in the broader economy to follow that Fed funds interest rate higher.
So Dan, given the steps the Fed is taking and the fact that we had a significant sell-off in May that moved the U.S. stock market anyway into a bear market territory, I think a key question we're all asking ourselves is, are we headed into a recession? And we did a fair amount of research over the past month and found that since World War II, there's been 12 different bear markets in the U.S., and 8 of those bear markets coincided with a recession in the U.S. However, in 4 different circumstances, there was a bear market, but there was not a recession. So our key takeaway was there's definitely not a guarantee that because we had a bear market in May that we're going to head into a recession. Based on that, what should we be thinking in terms of portfolio positioning and anything we should be doing as far as making changes?
Sure, Scott. So from looking at these 12 bear market periods going back to World War II, one of the major conclusions, which shouldn't surprise anyone, is that some of your strongest returns kind of come off that bottom. So not to say that we're at the bottom for this cycle, but at least we think we're near the bottom. Again, off 20% for most of the major stock indexes. So we wouldn't recommend selling out, going to cash at this point in time, just because those forward returns off the bottom tend to be some of the strongest that we've experienced. So the chart that we're looking at basically shows those returns off the bottom, and they're pretty strong if you go out 12 months. So some of the returns are more than double what the average return is for the average stock market. So again, just stick to your long-term plan. Don't make a bad decision by selling near the bottom where you have to buy in at a higher price level.
And to put it all together here, we've had a very unnerving start to the year. Stocks and bonds down pretty significantly. We've got the Fed starting to raise rates. We've got inflation concerns. That all said, there are some positives in the environment. We've got, the consumer looks pretty strong, the labor market's pretty strong, and companies have been still able to adapt and adjust and maintain pretty significant profitability.
Mm-hmm.
And as a result, we're of the opinion that we don't want to make any significant changes to the portfolio because we've taken the brunt of the downdraft, and we think we're probably near the bottom, so that we can't pick the exact bottom. And as a result, we're not going to make any significant changes to the portfolios at this point. So with that, we want to thank everyone for joining us. And as always, if you have any questions or concerns, please don't hesitate to reach out to us.